Let's start with debt versus equity, right? So when you look at debt, uh, what do people say that okay, why invest in debt? Now, when you invest in debt, while the volatility of that instrument is low compared to equity, it carries a risk of inflation, right? There is a high chance that even if you're investing in debt, you might not end up beating inflation, right? Now, you might say that okay, my objective is not to beat inflation, but maybe to create some extra money out of my own money. I mean, at the end of the day, the math still checks out with the fact that at some point, the debt in itself might not generate enough money or enough returns for you to beat inflation, right? So it becomes important that from a debt perspective, you look at assets which have low inflation risk. I mean, they do carry the risk of not beating inflation. So don't go for chasing yields, right? Now think of it in the construct of a bank. Today, let's say you take a loan from a bank, right, and you have a credit score which is above 780. The bank might offer you an interest rate of maybe about 12% for a loan of 1 lakh rupees. Now let's say for some reason you're not able to pay your EMI, right, and let's say you end up becoming an NPA, you don't pay EMIs for 3 months. What will happen is the bank will end up repricing your loan from 12% to 15% because the bank believes that you might end up doing a default. So there runs a risk in the way you're lending money, right? So that's number one. Number two, now when you put this into a context of a mutual fund, so when you're trying to invest in debt funds by looking at okay, which debt fund has given you higher returns, right? At that point of time, what ends up happening is because let's say A has given you higher returns or B has given you higher returns, we start chasing those schemes. But the fact of the matter remains, those funds have given you higher returns because they have taken more risk, or let's say they have lent to lenders which have, let's say, a higher credit risk. So while you may end up getting a higher yield, there's also a higher risk of default, right? Which as investors one needs to be careful of, right? Now, the interest income that you make from debt funds, it's taxed at the highest level, and this is similar to the interest income that you make from fixed deposits, right? Now, one also needs to understand that higher yields also carry higher risks, right? So that's something that one should be careful of. Now, when you look at equity helps you compound your wealth over the long run, right? So it's a tool of creation of wealth, but in a short term time frame, the volatility of equity can remain sky high, right? And there have been a few instances here and there, and I'll discuss about what my views were around this whole Axis front running thing that came to light. And then the whole incentive structure is made in a way the whole incentive structure is made in a way in which the long term capital gains are basically, I mean, you are incentivized not to take short term trades or short term redemptions, right? So the STCG carries a 50% higher tax than LTCG. LTCG is taxed at 10%, STCG is taxed at 15%, right? And then there's ELSS, which basically tells you that boss, for 5 years, just don't think about it. And for 5 years, your money compounds, number one. Number two, you get ATC benefits every year, right? So you end up, I mean, if you max out your 150 only in ELSS, right? So you make about, I mean, at the highest rate of tax, you basically save 60,000 rupees every year just in taxes. And then after that's done, you end up seeing how things pan out. I mean, after 5 years, the when you redeem, or let's say you need the cash, you only have to pay money in your long term capital gains at 10%, right? So that's something which is a little counterintuitive and at the same time helps you optimize your returns, right? So that's now obviously, Mayank, we'll come to the liquid funds for short term. Just give me 2 minutes. I'll just finish the whole Axis and the whole IPO debacle, and then we'll get into liquid and close it with actionable thoughts. So that's more or less with respect to what all we've covered till now: active, passive, direct, regular, dividend growth, debt, equity. Now, this big issue that came, and I got a lot of messages for this, so I just thought it makes sense that we cover it, was this, right? What exactly happened here? What is front running? What is the issue? Is the fund, is the whole industry in doing something which is a scam? So There is an underlying problem with mutual funds in India, right? And that problem is not a problem of abundance, it's a problem of scarcity. And let me tell you what, right? Now, what happens is, let's say if there's a fund which has about 10,000 crore rupees that it has to invest, right? Now, I'm giving an example. You can change the numbers, you can change the categories. Similarly, when I say a fund has 10,000 rupees to invest or 10,000 crores to invest, it will typically look at blue chip stocks or let's say the large cap stocks. Whereas if I tell you about a fund that has 1,000 crores to invest, it will look at small cap stocks, right? And we'll see both these examples in silos. So let's say we have a fund which has 10,000 crores in its fund and it has to invest in stocks. Let's say hypothetically it ends up investing in just 10 stocks, right? So what ends up happening is it has to put 1,000 crore rupees in each of these 10 stocks, right? Now for the fund to invest 1,000 crore rupees in a stock, the minimum market cap of that company should be 10,000 crores, right? Because if it ends up investing 1,000 crore rupees in a stock in itself, it will become probably 1% owner of the company. Now, let's say we say that no, we don't want the fund to be so stretched in its liquidity because the fund needs to ensure that it can move in and move out in a jiffy. So it will probably look at companies with more than 30,000 crores in market cap, right? Where they can take a 1,000 crore position, which is less than 0.3% of the company. And if they have to buy and sell, they can easily move in and out. So there is a problem of scarcity. So you end up just picking those 100 stocks. Now you pick 5 large cap random mutual funds. There is a 99% chance that there will be a 85% overlap on their top 10 holdings. Why is that the case, right? Why is everyone selling you the same product with different names? Because there is a big problem of liquidity and there's a big problem of taking meaningful positions for a fund to really show performance. And at some level or the other, the fund has to beat its benchmark. And that benchmark will carry a basket of 60 stocks, right? So the best thing for you to do is just to replicate a basket of those 60 stocks and say that, hey, I've beaten the benchmark, right? Which basically makes the value prop of an ETF so much better than, let's say, investing in a fund. But more on that later, right? So first, let's address what the issue here is. Now, what ends up happening is because 10 people are chasing the same stock, right? So think of it as 10 companies trying to chase the same talent. Let's say if tomorrow Sundar Pichai leaves Google, right? There is a high chance that Facebook, Amazon, Apple, Adobe, Salesforce, SAP, Netflix, Tesla, 8 companies will chase Sundar Pichai to be the CEO of their company. And all of them will just keep skyrocketing his comp package and will try and see that they get the best deal or they get Sundar, right? And that is also somewhat similar to what happens in stocks. So let's say, there was a few names that came out in this whole thing that these stocks were being front run, but this is not something which is new. This is also something, now I don't want to get into the nuances of, okay, this happened or this is bad or this is right. Obviously anything which is unethical is wrong, but I'm just trying to get to the core of the problem as to why has this happened and why one should not be surprised when they read stuff like this. So obviously there's a weird classification by the regulators where they say that only these stocks above X are large caps, only these stocks above Y are mid caps, and only these stocks above Z are small caps, which basically means that there's only a listed universe which of maybe 600 stocks that are investable in the first place. Any stock beyond that is non-investable, which basically puts out 70-80% of the stocks out of anyone's radar. That's number one. Number two, what ends up happening is because these stocks go out and okay, as an investor or as a fund manager which is managing the wealth passively of so many families, it's important to ensure that you don't end up putting risk into the system. But somewhere by being overprotective about these things, we have exactly done the opposite of what we sought out not to do, right? Because what ends up happening is, let's say we pick a stock which is X. Now stock X is at 100 rupees today. Maybe SBI bought it at 100, sold it at 200 to L&T because they will have to do bulk and block deals. They can't just offload shares in the market in cash, right? Because then the price will tank. From L&T, maybe it goes to DSP Mutual Fund. From DSP, it goes to Motilal Oswal. So there is obviously, for the same stock, because there'll be buying and selling happening, there is a high chance that the prices end up getting inflated, right? Which is sort of the Sundar Pichai example that I mentioned. So that is a big problem. And at some level, one has to sort of live with that until unless, the classification norms change or, You look at funds which are actively trying to find value in the micro cap space, but then again you run the risk of liquidity and also governance, etc. So one needs to be careful about these things, right? And it's not just limited to what Axis did and what came out, right? Some of these things have also come out, right? So you saw a lot of these schemes ended up investing in the Zomato IPO. There was a dividend yield scheme that invested in the Paytm IPO, right? So you will get to read stuff like that because, as I said, there is a problem of scarcity, and there is a problem that once these DII flows became so high, the fund suddenly realized, hey, where do we park our money, right? I mean, the obvious answer would be you just load up on your existing positions, but beyond a point, there is a issue of liquidity there also, right? Because if you have, let's say, a 300 crore position in a company which has a market cap of 10,000 crores, right, which is 0.3% of the company, and let's say your fund size goes up, you now manage 20,000 crores. So for you to top up, you have to add another 300 crores so that you match the weights. But then what ends up happening is, because everyone wants to be liquid, everyone doesn't want concentration, they just spread themselves thin and maybe allocate more stocks or more weights. So that is something which runs as a challenge when you look at these schemes, right? So obviously in the Paytm IPO also, Aditya Birla Capital, HDFC, Mirai, they invested close to about 770 crores, and that accounted for almost 9% of their anchor book. So just to sum up the whole equity example, this is a chart from the Capital Mind website. I would highly recommend you guys can also check it out. It's pretty epic. They collate this data on a monthly, annual basis. Now, if you look at the Nifty returns right from the year July 1999 to 2022, that's almost about 23 years. On an average, the Nifty has delivered annually anywhere between 13 to 14%. There were years when Nifty went almost negative 52%. Obviously, this was the 2008 financial crisis, and it has also given you returns of almost 80%. So if you look at a 22-year return framework, the mean returns would be somewhere in the 12 to 14% range, with a standard deviation that almost goes up 55% up or down, right? So obviously, if you remove 2008 and 9 from the equation, you might see standard deviation in the range of about 30% up or down. So that's basically to give you a perspective on how, over the long run, if you sort of zoom out, while there could be years of underperformance, there are also years of outperformance. So for you to really enjoy the benefit of compounding, you should ideally hope that you stay invested in the long run so that these aberrations are taken out thanks to time. The number two could be,